Hello again, everyone. Welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira, and I'm here with Shaokai Fan from the World Gold Council, a very special guest. He does quite a bit of research with central banks. So, Shaokai, I thank you for being here. And if you could, as a first-time guest, could you tell us a bit about yourself?
Sure. Well, first of all, thank you so much for having me. It's a pleasure to be here with you and your audience. So I'm the global head of central banks at the World Gold Council, and I'm also the head of Asia Pacific ex-China. So in my first role, I deal with all the central banks around the world. I engage with them on basically any matter related to gold, including giving them information, training, capacity building, etc. In the other role, I lead our market development efforts in markets in Asia outside of China.
So I guess I want to just first ask you, the central bank gold buying, do you still see that trend continuing?
Definitely. So as you probably know, central banks have been buying quite a bit of gold. The last 3 years have seen central banks buy over 1,000 tons of gold per annum each year. This year, so far in January and February, we've seen continued strong buying from central banks. So I think that yes, there'll still be buyers of gold. Whether they reach that 1,000 ton level that we've seen in previous years remains to be seen. Of course, the gold price is quite high right now, but that doesn't seem to have stopped them from buying gold in January and February. So I think, yes, overall, there'll still be strong buyers of gold.
What reasons would you say central banks are buying? And after that, what are the reasons why a central bank would then sell the gold that they're buying?
So there's a wide variety of reasons why central banks would hold gold. Of course, central banks are very familiar with gold as an asset class. They've been holding gold for centuries in some cases. Fundamentally, gold is an integral and important part of their reserve portfolios. And these are the portfolios that central banks hold to be able to back up their currency in times of market disorder, if they need to intervene, for instance, if they need to make sure their financial system is working properly. So typically they have to hold assets that are very liquid, very safe, because usually when they need to intervene, there's something bad happening in markets, and they need an asset that performs well when something is happening that is disrupting markets. They also need an asset that's liquid because they need to be able to sell it to be able to use it during that time. And of course, gold fits that criteria very well. So I'd say central banks hold gold, like I said, for a variety of reasons. One is because it fits their investment purpose as well. But another aspect is it's apolitical. It's not issued by any other country. It's not denominated in the currency of a different country. Every other asset that a central bank would hold is denominated in US dollars or euros or Japanese yen. Gold, of course, is not issued by another country. So there's no political risk if they're holding gold as well. So I think given that gold has those characteristics, central banks look to it as a way to ensure more safety and resilience in their portfolios. There's actually other reasons that central banks have been buying gold as well. Lately, we've been seeing a lot of central banks buy gold directly from domestically mined sources. And they basically want to be able to use the natural assets that their country has been endowed with to be able to source a reserve asset in local currency, and that's a big advantage. If you're a central bank from a country that has no gold production and you want to buy gold, you have to sell US dollars to buy gold. You have to buy the gold with US dollars. So you're selling one reserve asset and you're gaining another. But if you're from a country that has gold mining domestically, you can buy gold with your local currency, and then you gain a reserve currency as a result. So that puts them in a very advantageous spot.
The central banks, how important in this current environment that we're in, is it to have reserves that are not tied into any sovereign country, like you were saying, whether it be political or whatever it is?
I think it's an increasingly important consideration. Certainly not the only consideration that central bankers are thinking about, but given the uncertainty in the world, given rising geopolitical tensions, I do think that it's a bigger part of the thinking of central bankers than it was, let's say, 5 years ago or so. So that does add to gold's appeal because, again, it's not issued by any country. It's also a physical asset. So that means you can store it somewhere that might be a jurisdiction that's friendlier to you or in your home country if you prefer.
And I understand countries like, I believe, Poland, they've really been buying up gold. What reasons do you think they are buying gold? Same reason? I mean, whether it's some type of currency risk or geopolitical risk?
So you mentioned Poland, which is very apt because they were the single largest central bank buyer of gold in 2024. Of course, I can't speak for the National Bank of Poland. I don't know precisely what their calculations are, but their governor has said that he wants to raise their gold reserve levels to levels similar to their neighbors, basically. I think he might have mentioned 20% of reserves as a target. But in terms of why they're doing that, it could be you see sort of a destabilizing political situation, especially in the neighborhood of Poland. They're not too far from the conflict in Ukraine. And if anything, we've actually been seeing quite a bit of gold buying among central banks in Central and Eastern Europe specifically. Poland's the biggest, but the Czech Republic has been another major buyer, Hungary as well, Serbia. I think even recently Bosnia and Herzegovina added gold too. So that whole region, I think, has been turning to gold maybe as a way to ensure a little bit more resilience in their portfolios.
That number 20%, I've read a report. Emerging markets, they're looking to, let's just say, target 20% of gold in their reserves. And then I've also read where the developed markets, they look to target somewhere around 70% of their reserves. Now, you would know more than me whether this would be right or wrong, or if you have a different opinion through your research. But is that something similar that you find?
So I wouldn't say that you could just break it down into the emerging and the advanced countries and say emerging countries are targeting 20, advanced are targeting 70. I think that we're talking about over 100 different individual institutions that are responding to specific criteria, specific environments for their own calculations for gold allocation. So let's start with the advanced countries. So like the United States or Western European countries, they actually hold quite a bit of gold. Among the top 10 gold holders right now, I think they account for maybe at least 6 or 7 of the top 10, basically the US or Western Europe. But I would say that they don't have a specific target in mind. It's more like the gold that they hold is a legacy of the Bretton Woods system and previous international monetary systems. And they've held all this gold for a long time. They don't plan to sell any more of it, but they also are not maybe planning to accrue that much additional gold at this point. You have to remember that how they're managing their reserves is very different than how, let's say, an emerging market central bank like Thailand or Indonesia, how they're managing their reserves. The US, as the issuer of the world's reserve currency, would really never face a balance of payments crisis like an emerging market country would. So it doesn't really need massively large reserves to be able to intervene in markets like countries in Southeast Asia, for instance. And therefore, I don't think it's investing its reserves quite in the same way as an EM country. Now let's turn to the EM countries, the emerging countries. Again, we're talking about a very large number of countries that are all calculating how much gold they should be holding for different reasons. Some might include political reasons, so not entirely financial reasons as well. So, here in Singapore, for instance, the Monetary Authority probably has 4 or 5% of its reserves in gold, but then the Philippine Central Bank has over 20% of its reserves in gold. But the Philippines is actually one of those countries that's buying gold from domestically mined sources. So another sort of different factor that's influencing their calculation. So it's very hard to say if there's a single number that they're trying to all get to. I don't think they're trying to get to one specific number. I think every central bank has different targets in mind, but you have to also remember that they're managing their reserves for different reasons, and they're going to configure their reserves optimally for those reasons.
Yeah, that's a great point. In that report, I also saw China, which is considered an emerging market still. They hold about 8% of their reserves in gold. How does that number sound to you, 8%?
I can't get in the head of a PBOC reserve manager, obviously, but 8%, again, it depends on their needs, right? I think in China's case, they have very, very large reserves, obviously. They're currently the 5th or 6th largest official gold holder, something in that range, right? About 2,000 tons or so. So there certainly is more room for them to continue to diversify into other asset classes. And with the geopolitical situation now what it is, maybe they are thinking about ways to reduce exposure to US dollar denominated assets, right? And one of the reasons that central banks are buying gold, which I didn't get a chance to allude to before, is central banks are simply very limited in the assets that they can buy for reserve management. They typically need assets that are very safe, very liquid, which means they mostly buy government bonds, highly rated government bonds. If they need to diversify into something else, there just aren't that many other assets that meet that criteria, and gold is one of them. So I think there definitely is more room for the PBOC to continue to diversify, continue to buy, but It's really anyone's guess what their target is, if they have a target at all.
China does import gold. It imports quite a bit of gold. Does it export gold?
No, it's a net importing country, and I think there might be restrictions around exporting gold from mainland China as well.
So yeah, gold goes in and it does its job in China, I guess. Southeast Asia, Indonesia, Thailand, Vietnam. I just want to touch on these countries. What could you tell us about, let's say, the central bank and their gold, let's just say, policy, sort of, and the gold market, let's say, in Indonesia?
So let's start with the central banks in Southeast Asia first. So I already mentioned the Philippines. They are a bit of an exception because they have domestically mined gold. And I think at an average regional level, they probably have a slightly higher than average holding of gold at around 20%. They also tend to sell sometimes when they have adequate gold, and then they want to take advantage of a good gold price. They might sell the gold for US dollars at a price that's advantageous to them. Moving away from the Philippines, the Bank of Thailand has been another relatively large gold buyer, not so much in the last 2-3 years, but certainly I think in the last 5 or 10 years at least, they've been buying quite a bit of gold as well. So, they also value the use of gold. I think their governor at the time did say that gold is good for diversification, and certainly is a reason that we think central banks should be holding gold. In Singapore, the Monetary Authority, the MAS, they actually bought quite a bit of gold in the last few years. I think they've maybe doubled their gold reserves with their recent purchases. But given Singapore's vast foreign exchange reserves, even a doubling of their gold has only brought gold up to maybe 4 or 5% of total reserves, something in that neighborhood. So certainly more room for them to grow. But the fact that the MAS is adding gold after having been basically absent from the gold market for decades does send a signal, I think, of how important they attach gold to of the importance they attach to gold in their reserves. Bank Indonesia, not quite as active in buying gold. I haven't seen any buying and selling from them in recent years, but we can talk about the Indonesian gold market separately after this. I just want to finish our tour of central banks of the region. National Bank of Cambodia, they've been actively buying gold for a number of years now. They're not the biggest central bank in terms of the size of reserves or the economy that they look after, of course, but they have been supportive of the gold market. Brunei, I think they've been buying a little bit of gold here and there, but I don't think it's been large amounts one way or the other. Vietnam as well, State Bank of Vietnam has not been active, at least in terms of their publicly reported gold holdings for a number of years now. So then moving to the second part of your question about the local markets,
Sure.
Indonesia I think is a fascinating market. It is the largest economy in ASEAN, the largest population in ASEAN, also a gold producing country. So there's been quite an interesting development in Indonesia recently. The government has allowed for bullion banking services to begin, which means that there'll be financial institutions in Indonesia that can provide gold deposits, gold trading, that type of stuff to retail customers in Indonesia. And I think this is part of a strategy in Indonesia to capture a little bit more value from their natural assets. So I think it's an interesting time for gold there. Maybe it'll help gold to become more embedded among the local population, that ordinary Indonesians might consider adding more gold into their portfolios as a result of this liberalization happening.
When you look at that pie of gold, with a country like, let's just say, Indonesia, how much would be bullion buying? How much would be, let's say, jewelry buying? How much would be maybe ETF buying?
So ETF probably very limited in Indonesia. I don't think there are any ETFs listed in Indonesia for gold-backed ETFs at least. Between jewelry and bar and coin investment, I don't remember the number off the top of my head. Probably somewhere close to half-half if I had to guess, but I'm not entirely sure of that.
What about those same numbers for Singapore? Would you know them?
Singapore is probably a little bit more tilted toward investment, given the fact that we have a wealthy population here that has a little bit more excess capital to invest, and we have a lot of high net worth individuals moving their assets to Singapore. They can also invest as well. So I think overall, probably a little bit more investment gold in Singapore versus jewelry buying.
You went through some countries in Eastern Europe and you touched on Ukraine. So I wanted to ask you, what effect do you think the war in Ukraine is having with gold?
I think it's a little bit hard to parse out the specific Ukraine risk right now, because now we've entered into a situation where the gold price has moved up significantly, but I think largely because of policy uncertainty around tariffs, a lot of potential fear about what tariffs might do to the global economy. So the Ukraine risk, I think, is in there, but I think that it may not be a huge part of the movement in the gold price recently. Certainly, if the war ends, I think that would reduce geopolitical risk a little bit. And maybe you'll see the gold price react in some way, right? But I can't say for certain how much it might impact the gold price.
And tariffs, they are driving gold prices, gold, let's just say gold demand. You're seeing that driving the demand.
I think recently we've seen other asset classes perform quite poorly. Of course, the stock market is down quite a bit right now. So yes, I think there's some haven inflows into gold around trying to manage the risk of tariffs. So I do think that's a big part of why we've been seeing the gold movement, the gold price movement recently.
I want to get back to ASEAN. Vietnam, I've heard, I don't know if they're still number one as far as gold buying. What would be the top three countries in ASEAN?
For gold buying. So Singapore is a little bit outsized because not just because of its purchasing power being larger than other countries in the region, but also because of its role as a regional hub. So if you look at, for instance, the World Gold Council data on Singapore, you'll get quite a bit of gold demand per capita, which might not actually be purely domestic demand in Singapore. It might reflect its regional role as well. So if you strip out Singapore, you get Vietnam, Indonesia, Thailand probably as the three largest buyers of gold. I think Malaysia is also in there as well, but maybe not quite as big as some of those three countries that I mentioned before.
Shaokai, you've been doing this for a while. In general, what are maybe the one or two things that you found fascinating or amazing in your research?
I think last year was quite an interesting year because we've seen sort of this classic relationship between gold and US rates and gold and the US dollar start to weaken. And I think it's probably a sign that there's a lot of non-US driven investment into gold right now. Of course, central banks are a big part of that. The traditional reason for why there's this relationship is, of course, gold has no yield, it has no dividend. So when US rates are higher, it creates more of a disincentive to hold gold, right? And vice versa. But if you have investors that are buying gold for reasons that are nothing to do with US rates, nothing to do with Fed policy, then suddenly that relationship's going to start to weaken a little bit, which is something we've been seeing in recent months and years. So last year, for instance, we had a lot of retail buying of gold in China. And that was because Chinese retail investors were concerned about other asset classes not performing well. The Chinese property market famously is not doing very well. The equity market in China, at least at that time, was not doing very well. So a lot of investors were turning to gold as a way to diversify their asset holdings. And they were doing so obviously for reasons that have nothing to do with the US dollar and US rates. They were buying for their own specific reasons. Central banks as well, they've been buying quite a bit of gold. Whether it's for financial or political reasons, it may not have anything specifically to do with where the Fed is and where the dollar is at that moment, right? So we have all this additional buying coming from actors who are not specifically focused on that link between gold and US rates. So that might lead to a weakening of that relationship, which is something we've been seeing lately. In the past couple of weeks, sometimes the dollar goes up, gold goes up. Sometimes the dollar goes down, gold still goes up. So it's not that classic relationship anymore. So we might be moving to a new paradigm of gold's relationship with other asset classes.
It's interesting. So that inverse relationship may be disappearing somewhat or changing?
I would say it's weakening. It's still there, and it's still going to be a significant influence, but it's not quite as much of an influence as it was before.
I saw an article you wrote in a blog, the future of money or the evolution of money. How do you see money evolving, and what role do you see perhaps gold playing?
That's a very interesting question, very deep question, obviously. Money's been one of the greatest inventions of humankind, because it really solved for the problem of how do you trade for goods and services if you don't want what the other person's offering. So the advent of money really solved for that, being the intermediary, the medium of exchange between two individuals or contracting parties or what have you. Of course, gold used to be money directly. We used to mint coins and use gold coins directly, right? And then it became the basis of money as part of various different gold standards and eventually the Bretton Woods system. But since the early 1970s, gold no longer has a formal function in the international monetary system. Our current system is based on fiat money. And the system has its flaws, of course, but it's been going on for over 50 years now. It hasn't eradicated gold. Gold is still, I would say, more important than ever as a financial tool. It's just not a formal part of the financial system anymore. So in terms of the evolution of money, of course, we're going to start talking about cryptocurrencies, for instance, central bank digital currencies. And I do think that they have their role, but I don't think they'll displace traditional fiat currencies. I also don't think we're going to return to a gold standard either. I think that we have evolved to a point where gold has its own important, unique role in the financial system, but it doesn't necessarily have to back specific money. I also think that we're going to enter into a period of continued sort of competition between nation states using not just hard power in terms of military assets, but also their economic power as well, including the power of their financial system. So, the US, of course, has the exorbitant privilege of hosting the world's largest reserve currency, which means that it can gain enormous benefit, but it can also weaponize the dollar and use it as a potential cudgel against people it doesn't like. I think that given that we're in an increasingly fractious international political system, that our currency system might see some fracturing as well. I don't think the dollar is going to suddenly be displaced and disappear, but I do think that we're going to see a gradual erosion of the dollar's role and the rise of potentially other currencies. So we move into maybe a multi-currency system, not one that's just purely dominated by the dollar. That being said, I think this is going to be a long, drawn-out process. It's not going to be all of a sudden, like because of World War II, we saw the dollar replace the pound sterling. I think it's going to be a very long-term change and evolution, if anything.
Shaokai, you touched on gold as a currency, and I just spoke with Julie Shelton, and she's floating the idea of a 50-year treasury bond that can be backed by gold, where it's redeemable upon maturity by fiat or by gold. So I just wanted to ask you, should something like this take hold, do you see it possibly being a trend?
I think at this juncture in history, a lot of things are possible. Certainly, we've seen the administration in Washington start to think of different ideas, maybe ideas that we hadn't considered before. So I won't rule anything out. It's definitely possible. But I think if you look at India, for instance, they've had a sovereign gold bond for a number of years. Not quite the same thing you're talking about. In India's case, it's actually a synthetic instrument that's not backed by gold, that in many ways was designed to try to get Indian investors to buy something else because gold was becoming such a drag on India's current account. It was creating current account issues for India. So we have seen governments sort of mix gold in with sovereign instruments before. So again, I wouldn't rule anything out, but I don't know of any specific plans either.
Shaokai, final thoughts on gold. What would you say about gold to someone who maybe hasn't invested in it yet or thought about investing in it yet, but they're hearing gold prices rising, central banks are buying gold? What would you say to that person?
So I actually get this question quite a bit because certainly the people I talk to, when they find out what I do for work, they always ask me about, should I hold gold? Why should I hold gold? I think the first thing that people should consider is that gold is an asset class that, of course, has been around for a very, very long time. That means that it has inspired existing opinions in a lot of people. I think a lot of people have strong, maybe even calcified opinions about gold already, but whether good or bad, to be honest. But I think that we should try to transcend those opinions and look at gold from a modern financial angle, which means that if you examine gold's characteristics, if you look at its financial behavior, its correlation with other asset classes, you put it into an asset simulation, optimization software, for instance, you can see that in almost every case, for almost every type of investor, there is a need or a benefit for having gold in a portfolio. And that benefit often draws from the fact that gold performs unlike other asset classes. So gold has low correlation to equities, for instance. It is a safe haven asset, but at the same time, it can also deliver returns even when times are good. And that stems from gold's multiple uses as an asset. Of course, we're mostly talking about the financial use of gold, right, which is roughly half of gold demand. But then you have that other half of gold demand that's not financial. That's jewelry demand, for instance, or gold as an input for technology, circuitry, industrial uses. That half of the gold market is pro-cyclical, which means that when times are doing well, when people have more money, when the economy is booming, people tend to buy more jewelry and they buy more products that contain gold in it. That leads to gold's performance being very different than other asset classes, which means that it has very low correlation. If you add an asset class that is low correlation to your portfolio, it improves diversification and can actually, in many cases, improve risk-adjusted returns. So I would look at gold as a component to almost anyone's portfolio. We think it'd probably add value to virtually all portfolios out there. And look at it from a scientific financial point of view. Try to ignore whatever long-held emotional value you might have to gold, whether it's positive or negative for that matter. If you think that gold is an asset that does nothing, it doesn't give any dividends, it's just shiny, it looks nice, maybe try to examine gold more from a financial sense, right? And see how its performance stacks up to other asset classes and how it might impact your portfolio overall. And you might find that having a bit of allocation to gold will improve your overall portfolio performance.
All right. Shaokai Fan from the World Gold Council, we appreciate your time and your insights. How can people follow you and see more of your work?
So we have a great website, a resource for anyone out there. It's called Gold Hub, www.goldhub.com. The World Gold Council's research, analysis, data is all on that website for free.
Okay. Shaokai Fan, I want to thank you for stopping by.
My pleasure.
I hope we can do this again soon, and let's see where gold goes in the rest of the year.
Absolutely. Thank you.
That was Shaokai Fan from the World Gold Council sharing his views on the economy and central bank gold buying and selling. To see more Shaokai's work, visit goldhub.org. If you like this video, please do subscribe, share, and give it a thumbs up. All are greatly appreciated. Audio-only versions of this interview can be found on iTunes and Spotify.